Hi, Dan Finn with Finn Financial Group here again, and today I'd like to spend a little time demonstrating to all you current or prospective retirees something you may not have considered or even heard about for securing your future. It's called a fixed indexed annuity, and I believe after watching this demonstration, you'll better appreciate why over $125 billion worth of fixed indexed annuities were purchased in 2024 alone, and why it may be something worth considering for a portion of your own portfolio. After watching this video, please reach out to me and I'll be happy to send you links to articles and white papers from the likes of Forbes, BlackRock, and Barclays, among others, all of whom are now touting this strategy as being superior to investing in bonds. Okay, moving on to the presentation. Before we get started, just want to point out that this whole thing is for illustrative purposes only. This is no tax, legal, accounting, or investment advice. This is an educational option, and we're not talking about any specific life companies or products, just an educational analysis. And I've also shrunk this spreadsheet down a little bit so it's easier to see, because when I did it the first time, you couldn't really see it the whole size. So hopefully we're going to jump around a little bit. Hopefully it won't be too distracting. So we have a hypothetical retiree who's 60 years old, and between his work history, his company match, he's managed to sock away enough money that now totals about $1 million in his 401k. He is 60 years old, and a good prudent investor rule is to take 110 minus your age. So he takes 110 minus his age, and he has 50% of this invested in stocks. You shouldn't be overexposed to stocks as you age. And like most people, if you have half of it in stocks, most of the time they're going to say put the rest in bonds. So you balance it out. Some people are 60-40, some 70-30, depending on your age, is going to determine how much you're going to have in stocks. The stocks, of course, are high risk, high return options, whereas the bonds are moderate risk, moderate return options. And between the two, they should work nicely over time. Now, a third option that the financial advisor is probably not going to be discussing with him is a third safe bucket option that is a no risk, moderate return option, even less risky than bonds, and the moderate returns that I think you'll see are going to even be better than the moderate returns that the bonds are returning. I'm going to talk about two fixed index annuities here. The first one is in this safe bucket is called a fixed index annuity with a cap. And what that means is when you invest a certain amount of money into one of these, from point to point, from one year to the next, your balance will increase based on whatever the index does, whatever you're invested in. Let's say this one's the S&P 500. So if the S&P 500 increases, you get whatever appreciation is credited to that account, subject to a cap of 5%. So that means if the market returns 10% or 20% in a year, then you're only going to be limited to 5%. The trade-off is that if the market is negative in any year, you never lose anything. So that's a compromise you're dealing with here on the fixed index with a cap. There's a second one over here in the olive green column that's called a participation or par rate. This one is limited similarly to whatever the index does. In this case, let's say the S&P 500 is got a par rate of 40%. So that means if the market goes up from point to point, from one year to the next, you're going to be limited to 40% of whatever that index returns. So let's say the S&P 500 goes up 10% in a year, then your account will be credited 4%. But again, will not lose anything because it never goes down. On this one, we're going to show a 1% management fee. The fund manager or the retirement account is going to have some management fee in there, depending on what your services your advisor is providing. This can range from anywhere below 1% up to 1.25%, sometimes even 2%, depending on what's going on with your account. This varies, and I'm using 1%. That seems to be a pretty good average. Now, for this particular demonstration, we're not going to be talking about the COLA or any withdrawals, but we can do that later on other individual analyses if anyone is ever interested. So let me go ahead try now to scroll down and see what we, I got to resize this a little bit. Okay, hopefully this is still not too distracting. It's tough to do. Whoa. Okay, I think I want to make it a little bit bigger. Okay, this is probably close. Okay. All right, let's go ahead and look at this one here. Okay, so now we have over in the growth bucket. Remember, they had $1,000,000. He had half in the stocks and half in the bond portfolio. And what we've done is, can't quite see it on the left, but what we've done is gone past the last 20 years and said, let's look back and see what did the market actually do over the last 20 years. And let's pretend that we could go back in time, take this $1,000,000 20 years ago and deposit it then. And if we had all these factors in place, what would that $1,000,000 be worth today? And so we go back 20 years. 20 years ago, the S&P 500 returned almost 9%. After the 1% management fee, it was dropped down to 7.9%. So in this particular situation, that first year, this individual received 9% on his money. The bond fund, that same year, returned 4.34%, but after the investment management fee, it's down to 3.34. So over the 20-year period, you can see that the market did pretty well. With a couple notable exceptions. I mean, this was generally a pretty good run for the last 20 years. Now we had, of course, the Great Recession, minus almost 40%, minus when you factor in the management fee, and then the COVID years were not good for anybody. Dropped about 19% over 20 once you had your management fee put into it. On the bond side, during the COVID year, the account increased by 5.25 or 4.25, but also in the COVID year, the bond funds even lost money. A lot of people don't realize bond funds can lose money, and that's something that you should consider when we're talking about these other options here. Now let's go ahead and scroll over a little bit to the side here. And you can see over here down at the bottom where the stocks and bonds, $1,000,000 turned into almost $3 million over that 20-year period of time. Let's take a look at those two options that we didn't factor in. Remember that first year where the market did about 9% because the 5% with a cap, the index with a cap was 5%, so it was limited to 5% that year. The next year, the second year, the market returned 3%, so that's what the account was credited, and on and on. The Great Recession year, this did not lose anything because you never lose money when you're in a fixed index annuity. Same with the COVID years. Add it all up and you've got a couple good years where you got 5%, a couple zeros, and a few that were right in between. Similarly, if you take this first year, you go back 9%, 40% of the 8.99 is 3.6%, and then so on and so forth. And the COVID years, again, or rather the Great Recession year, nothing lost. COVID years, nothing lost. But these were options that were not selected, so it's not anything that you can really look at and compare it because you're still ended up with your 2.9%, $2.94 million. But look at the percentage here. The bond fund returned 2.19%. The index with a cap returned 3.64%, and the index with a participation rate returned 5.11%. So that's like 2.5%, 2.5 times better than what the bond fund is doing. So okay, so let's go ahead now and let's shift back up here for a minute and let's change this. Let's just say I'm back over up to the upper right hand corner now. I'm going to go ahead and take this and move some of this down to here. Let's just say that this particular individual decided that he wanted to take 50% of his bond bucket and change that to 25, and let's say he liked the par rate. Let's see what it would have been if we had 25% 8% in the bond bucket, or in the par bucket instead. Let's take a look now and see how that would have impacted his balance. Over here to the right hand side, still the same averages don't change, but look at this. You can see that he would have received about over $300,000 more money just by investing in the fixed indexed annuity instead. So that's not insignificant. And by the way, one last thing here, these numbers that we were talking about up here, these are relatively conservative. We're saying a cap rate of 5% right now. I mean, you could easily get one for 6%. I personally am in one that was 10.25%. Right now it's 10% for anybody that's investing, which is pretty good, so twice as good. And the participation rate here is 40%. It's not unreasonable to think 60% or even 80% is available right now. Let's change this now. What if you did change this to 80%? What if you could get 80% and it stayed like that throughout the duration? Let's see what that would have done to your balance. That would have even more significantly improved the payout. So the numbers I'm using here, when I put these to 40% and 5%, these are pretty conservative options, and I think that's significant to keep in mind as you're looking forward to this. See how it might benefit you. Okay, so that's it. If you have any questions, give us a call. If you're intrigued by this option, want to learn more, for most people, reallocating some portion of your safe money from a bond fund into a no-fee, accumulation-only fixed indexed annuity is going to be an ideal choice. As we've demonstrated here, these are historically proven to be better than a bond portfolio, and you're likely not going to hear these from your financial advisor. If you talk to them about it, they probably will downplay all their benefits. But I think if you take a close look at them, it might be worth considering. And consider this not just for your retirement account. This would also be worth looking into if you've recently settled a personal injury claim and for whatever reason did not structure your proceeds. Maybe you're a plaintiff attorney who just resolved a major case and are unsure how to best protect your money, or maybe you just sold some real estate, received an inheritance or some life insurance proceeds. We can go over your own personal situation and see how you might benefit. Well, that's it, everybody. Thank you for taking the time to watch this. Best wishes for continued success in your personal and professional lives. If you found this helpful, hit the like button, and please let us know if there's anything we can do to help you with your future income planning. Thank you for the opportunity to be of service, and have yourself a great day.